Good afternoon, everyone, and welcome to our webinar today. Today's webinar is entitled Strategies from the New Tax Law to Boost Growth, Value, and Succession Readiness. Now, in this timely and informative webinar, Stratus Business Advisors founder and CEO Sam Brownell cuts through the legal and accounting jargon to provide dealers with key items from the new tax bill that was signed into law in July. The discussion will center on what rules can have the biggest impact on dealers' growth, profitability, valuation, and succession planning. Plus, Sam will focus on what dealers can do right now to ensure that they are using the provision in the new tax law to build sustainable growth and profits that will increase the value and marketability of their business. Now, regardless of whether you are thinking about succession planning, it is never too soon to build a business that is primed to sell. Now, having said all that, just a few pointers. Now, all the attendees are muted, so you can hear us, but we can't hear you. So if you're having any technical issues, click on the chat button at the bottom of your screen to send us a message, and we'll do our best to fix that problem as quickly as possible. Now, if you have questions for Sam, type those in at the Q&A button at the bottom of your screen, and Sam will answer as many as possible during our time. Now, the webinar should last about 30 to 40 minutes, and we are recording it, and a link of the recording will be sent to everyone who registered, plus we'll have it posted on lbmjournal.com. So having said all of that, I want to turn this over to Sam. Sam, welcome. And as always, thank you for taking time out of your schedule to be with us and to share your knowledge.
Yeah, my pleasure, Mike. My pleasure. Thank you, as always, LBM Journal for having us. We're excited to be here. Sort of could be a dense topic here, but we're going to try to make it interesting and connect it to two things that are really important to dealers, especially when we're thinking about the future. One is profitability, and one is readiness, right? Succession readiness. Those are two highly important things. This new tax law gives us some benefits and some advantages that we can really focus on. So. Without further ado, we'll jump right in. So just a quick disclaimer up front for everybody is we provide business valuations, we provide succession planning, we do a bunch of work implementation coordination wise, we do financial planning work, risk management, all wrapped together if need be. We are not attorneys, we are not CPAs. What we are providing here are some strategies that we want you to think about, but please make sure that if you have questions that are specific to your business, that you either reach out to us directly, and more importantly, that you talk to your CPA and or your tax attorney. Those are the folks who are going to have the best idea about what's going on for your business. Now, having said that, one of the things that is really important is that no tax cut or tax benefit is necessarily going to give you a huge boost in valuation. It's what you do with these new provisions and how those provisions themselves can help you boost growth, drive more money to your bottom line, which ultimately will result in a higher valuation for your business. So that's really what we want to talk about today. There's no silver bullet out there. There's no, oh my gosh, just because this tax cut happened or because this tax was enshrined on a more long-term basis, that all of a sudden your business is going to go from being worth 5 times to 6 times. That's not the way that this works. This is giving you, and each one of these 8 areas that we will go through will give you an opportunity to build a business that is growing better, where you can increase margins and ultimately drive money to the bottom line, make that business one that people want to take over. Boy, they've got a lot of good young folks there. They've been able to recruit and retain. Wow, look at those processes they've put in place. Look at the way they've used technology. Those are the types of things that we're going to talk about today, because that ultimately leads to long-term value, not just a one-time spike. That's what we're trying to avoid. Businesses get valued on their ability to create sustainable cash flow. So Let's start out right here with income tax rates. And this is going to be important for a lot of folks, especially those who are S corporations or LLCs, right, who are a pass-through. So they extended the current 7 tax brackets. In fact, some of them have actually expanded in range, especially once you get below the top tax bracket. Top marginal rate stayed at 37%. Standard deduction was increased. And now one of the interesting things here that we'll talk about a little bit later is that the standard deduction typically means that you can't itemize, but there are areas such as charitable contributions or such as the overtime deduction that your workers may be able to take that we'll talk about down the road that can be taken even if you use the standard deduction. That was not typically the case beforehand. You either itemized everything or you took the standard deduction. Now there's some overlap. Really important to think about. This idea of C corporation tax rates, they remained at 21%, and this is going to become important when we get to that extension of the qualified business income deduction, right? That has tried to level rates more or less between what's going on with a C corporation and what's going on for you folks who are pass-throughs, S corporations, or LLCs. So the question really is, all right, now that we know what's happened with tax rates, how does that impact value? What do we do? And so we talked about this a little bit more. If you're an S or an LLC, right, that's a pass-through entity, that's where you're paying taxes, particularly at the federal level, as an individual, right, not on the corporate level. And so let's think about, can we potentially get income into a lower bracket? And we'll talk about ways to do that coming up with some of these things around depreciation and expensing. But if we can lower taxes, we've got higher after-tax cash flow. Higher after-tax cash flow leads to higher valuations. So that's going to be a really important thing to think about. There's this other piece here when we start talking about taxes and value, is that, remember, there's value to your business, and then there is your net worth. And when we think succession planning, we want to look at both. And the reason we want to look at both is because ultimately the sale of your business is a taxable event. If we can move money outside of the value of the business, if we can stock up net worth elsewhere, that's an opportunity for us to delay or potentially eliminate paying taxes in the future. And so for those of you who are running profitable organizations, this idea of a cash balance plan could be a really useful one, right? And what this is this allows you over a period of time to put away a lot more money than you could into a 401k, right? You put away about $31,000 this year if you're over 50 in a 401k. Cash balance plans we're talking about in the hundreds of thousands of dollars, and these could be over 5, 6, 7 years. And so the cool thing about a cash balance plan is you can stock away a lot of tax deferred money. You take a tax break now, but cash balance plans are typically not an ongoing expense. You fund them over a certain period of time, 5 to 7 years, let's say, and then that expense goes away. So that could potentially be an add back, right? A way that we can adjust cash flow back up while you're also putting money into an outside vehicle, a tax deferred account that is separate from the value of your business, so that we're diversifying how we grow our net worth. Really, really important thing to think about here as you're thinking about how to grow value, how to protect your net worth, and how to make intergenerational wealth. Let's switch gears here and look a little bit about this state and local. Okay, this is a big one, especially if you're in a high tax state. So remember, with the old Tax Cuts and Jobs Act back in 2017, this was reduced to $10,000. Okay, it's been increased to $40,000 for 25. It's going to go up at 1% every year until 2030. So think about what that does for folks in higher tax states. Right? This is an opportunity to deduct more money than you could in the past. And that is combined with this pass-through entity tax not being limited, right? We can use our business to take some of these taxes and use this deduction to reduce income. Mike, I see you're there. Do we have a question?
We do. We have our first question today, and it is, did the tax law make any changes to the taxes I might pay on the sale of my business?
Yeah, okay, that's a great question. So that's a really good question. So there's this idea of value that goes with your business, and that's related to the income taxes, franchise taxes, things like that that you pay. Then there's this other piece, which is the sale of the business. And so from that perspective, not much has changed. What has happened is things have been codified a little bit more, right? We now know, for example, that if we're selling stock in our business, that there have really been no changes to long-term capital gains rates. And that's going to depend 15% for everybody, but the lowest tax bracket, which is zero, or 20% for that highest tax bracket. And so nothing has really changed there. Where it has changed a little bit, and again, more of it is the codified pieces. In an asset sale, it's a mix, right? You pay some ordinary income tax, you pay some capital gains tax, depending on how your purchase price is allocated, right? Purchase price that's allocated to things like receivables, inventory, fixed assets, that's ordinary income. Things like land, goodwill, that's going to be long-term capital gains. So there wasn't a huge change to the tax on the sale, but as we mentioned a little bit on the previous side, there will be taxes on the sale of your business. And so having things in place like a cash balance plan and doing tax planning heading into that sale to try to keep your income in that sale year as low as possible can actually be really helpful because ultimately it's the net that we're taking away from a sale that makes the difference, right? It's very exciting to say, oh my goodness, my business is worth $10 million, but you're not walking away with $10 million. And if you're not careful, 30-40% of that could be ended up and paid out in a check, right? So $6-7 million looks a lot different than $10 million. So it's a great question and a really important thing for folks to pay attention to as they get into this planning phase and as they start thinking about where value is coming from in terms of their overall net worth.
Well, we have a follow-up to that. And
Sure.
as a follow-up to my question, how might these new rules affect the valuation of my business if I plan to sell or transfer ownership in the next 3 to 5 years?
Yeah, so that's a really good question, and we're going to get into some of it right now, Mike. And this whole idea. Let me just go to the next slide because this will be one of these areas. Is so this state and local deduction. This is not something that is put into the new tax law that doesn't have an expiration date, right? This is going to expire in 2030. In 2030, without additional changes from Congress, this is going to go back to $10,000. So that's within that next 3 to 5 year window. And so in that window, this is a planning opportunity for you to pay less in taxes now, but also have the benefit of what is a non-recurring deduction, right? This SALT tax is not going to be around forever. And so if I'm valuing the business, what I want to know is partially what are the expenses that are ongoing? What are the deductions that are ongoing? And if I'm not taking a $40,000 deduction, but I'm taking a $10,000 deduction, that's a 30,000 boost to cash. Right? It doesn't sound like a lot, but you add enough of those up and it makes a difference. So if you're in that kind of mindset of the next 3 to 5 years, a lot of what we're going to talk about here becomes really important. And even if you're not, right? Even if you're looking beyond 5 years, things like the timing of tax payments. Can I pull payments in from 2030 to 2029 to reduce my taxable income before that state and local deduction is reduced again? Those are going to be really important things to sit down with your accountant and plan for on the horizon because it comes up quicker than you think. I mean, 3 to 5 years is not that much time, as anybody knows, and a lot can change. So thinking about it now and determining if I'm going to sell in 3 to 5 years, what are those one-time or non-recurring expenses, deductions that can help my tax bill now but won't count against my valuation? Really, really important. If you're looking longer term, how do I use some of these provisions, even if they're going to expire, to help me in the taxable side, gives me more money, reinvest in the business. Reinvest in the business is a great way to grow the business. Growing businesses typically more marketable, typically more valuable. So with that, let's talk a little bit about one of the biggest items, one of the biggest concerns that we hear all the time in the industry is recruiting and retention. We just can't get the right people. If we get them, we can't keep them. Boy, I wish I could sell to my employees, but there's just nobody that I've been able to find who can do this, who can run this organization. Right? All variants on the same point is how do you incentivize people? How do you get them into an industry and how do you keep them there? And the tax law gives us a couple opportunities. One of them is this overtime pay. Again, this is not a permanent or a non-expiration provision. This is just during the current administration. But what it does is it allows your employees to take a deduction, 12,500 for individuals, 25,000 for filing for joint filers. All right. And they phase out at fairly high levels. Right. For most of your workers, 150K for an individual, 300,000 for a joint filer. That captures a lot of people. And the fact is it's available to non-itemizers. Right. So if I'm going to take that standard deduction, I can also take this temporary deduction on overtime pay. That could be big. This could be a really good thing to motivate folks to put in a little bit of extra time. They may be able to see a benefit from it on their tax return. So this is available just for these 4 years, 25 to 28. So think about how this could work. All right. It's not from a business standpoint going to make a huge difference because you still have to pay those FICA taxes, right? But if we can get a few more people to stay, if we can reduce turnover, if we can keep those good young folks who we think may be able to move up in the company, that's a good thing. And this is a good provision to potentially take advantage of and to have in the back of your head when you're having those conversations. Hey, I'd really like you to be able to stay around a couple evenings. I could really use the help, or we need you to come in early, right? We've got some big deliveries coming and we could use the extra help. And there's a benefit in it for you, right? Never forget the fact that giving folks a little bit up front can make big dividends down the road. Showing a little bit, investing in people can make a much bigger impact down the line. So this is just one way to do it. We'll talk about a couple others as we get further into the presentation. So for owners, this is something we talked about a little bit earlier. This is this idea of qualified business income deduction. Most of you are probably fairly familiar with this, especially if you're an S Corp, S Corp LLC, right? This is how they're trying to even out that 21% corporate rate with the pass-through rates. The deduction is going to remain at 20%. There's no expiration date on it. So that's good. So that provides a little bit more clarity in terms of planning, right? And this planning could be big because A, it's excluded from itemized deduction limitations, right? There are some limitations, especially if you're bumping up into that top tax bracket, and we need to think about those. But this is a good one to sit down with your accountant and think about, all right, is our entity structure the best? And maybe we've been a C corporation forever, right? My grandfather started the business. My great-grandfather started the business. There were only C corporations. Is that still the best structure for us? This is a conversation to have with your accountant, have with your tax attorney. It can make a difference, and it can make a difference really in two ways. Number one is the way that you run your business in a C corporation is a little bit different, right? You don't want to necessarily distribute a whole lot out of that C corporation because of the double taxation. Also, if you're a C corporation and you're looking to sell to a third party, right, a competitor or private equity backed roll up, in that asset sale, you're going to be taxed twice, once at the corporate level and again on anything that is distributed to you from that C corporation. And so a lot of planning has to go into how do I maximize taxes if I am a C corporation and I'm going to sell externally. The other thing to think about here too is there are ways to plan for the QBI, right? What type of income are you paying out? What type of bonus structure are you paying out? How does that impact your QBI? Could it be better that you did end up as an S corporation instead of a C corporation because you have a little bit more flexibility in how you move around compensation, let's say, to maximize your QBI? So thinking about this ultimately leads to the question we talked about it earlier, is more dollars. If we have more dollars, we can invest those dollars productively, whether it's in technology, whether it's in people. That's what we want. That's where growth comes from. Okay, these are big ones, and these are big ones for a couple of reasons, right? Bonus depreciation and expensing. Remember that under the old tax law, the bonus depreciation slowly started to phase out, right? It was 100%, then it was down to 80, 60, 40. All right. And if the bill hadn't been passed, it would have gone to 20 and then back to zero. So this is something that is really important, especially as we are considering making investments in the business. There's a difference, and from a valuation perspective, there's a difference between me making an investment and just a straight expense. Paying for my finance manager's salary, that is an expense. That is something that we're going to incur every year. Investing in new technology, upgrading the roof of our warehouse. Those are investments. Those are investments that can pay off with higher return, higher growth, ultimately higher value. And this is a great opportunity to do that and take a tax break. The whole reason that these two provisions were put in was to try to help business owners invest in their businesses. Yeah, Mike.
All right, we have a question. Does bonus depreciation have anything to do with employee bonuses? I am confused by the terminology.
Yeah. So that's a very good question. And so no, it doesn't. It doesn't have anything to do with the bonuses as in things that are paid out to our individual employees. This has to do with the fact that instead of taking, let's say we bought an asset for $1 million and it had a 5-year useful life, right? We could probably do one of two things. We could either do it as a straight line. We take $200,000 of depreciation every year, or we might be able to accelerate that depreciation. Maybe we do 40,000 to 400,000 the first year, then we do 300,000, then we do another 300,000. Okay. That is part of depreciation. So bonus is basically giving us the opportunity to take extra depreciation, right? It's a bonus. So we can depreciate up to 100% of that purchase, $1 million. And we can take 100%, $1 million, depreciate that full thing, and that can really help from a tax perspective. Because remember, depreciation affects the business in a couple ways. Number one, it's a non-cash charge. Okay? We are not writing a check like we are if we paid $1 million to an insurance claim or something like that, right? This is non-cash charge. So it reduces our taxable bill, but it does not impact our valuation. We are not taking a knock on net cash flow because we depreciated more than we could in the past. And that's really important because regardless of whether you're looking at a multiple approach, right? We're looking at a multiple of EBITDA, right? Earnings before interest, taxes, depreciation, and amortization, or we're doing a cash flow based valuation like a discounted cash flow, that depreciation is going to be added back. So if we had $2 million of net profit before taxes and we took $1 million of depreciation, well, our net cash flow is actually $3 million. That makes a big difference. So what I'm hoping folks are seeing here is that the benefit of this type of depreciation is that you can make a decision. Sit down with your accountant. Do I depreciate it all in 1 year? Do I spread it out over multiple years? Are there years where I think there might be higher income? Is it worth it then to make an investment and then depreciate in that year? Save me some taxes. And so really it comes down to what type of assets you're buying, right? Typically the Section 179 expensing, longer life assets, assets that are related to updates, upgrades to your infrastructure, to your buildings, to your property. 168 is typically better for short-term assets, right? New forklifts, new truck for the fleet. So think about how these types of benefits help on the tax side, but they also don't ding you. They're not a negative on the valuation side. And that then can free up cash that is not paid for taxes to invest, upgrade that technology, provide that bonus or raise to that next generation. Think through how cash can be put to use, even in the short term, that is long-term return on investment. That's really what we're looking for. Okay, couple good provisions in there that we're hoping will be a boon for home building. One of these is this the housing tax credit, right? There's an increase to the allocation to each state beginning next year, and it's lowered this what's called the private bond activity financing threshold. This was a big sticking point with contractors trying to get financing for projects. And so making it a little bit easier for them to do that is good. And one of the things that we want to do as people that are selling to these folks, as dealers, right, as they are our customers, is let them know, right? The best thing you can do is help your customer's business make money. That's a great way to get really good, tight relationships and have repeat sales. That's huge because that then leads into that sustainable growth. Sustainable growth leads into sustainable profits, and sustainable profits leads to higher valuation. So think about how can we help our customers improve their businesses? Because now you've got a customer that's much more bought in. They're listening when you're talking now. Wow, these folks told me about this. They told me that I should potentially go to my local chamber of commerce or housing authority and ask, what are we doing in this state? What type of allocation are we getting? Now I can turn around and have that conversation with the folks who buy from me. So really, really important that we're thinking both internal but also external. What's happening downstream? What's happening upstream? How does that all fit together to make my business more resilient, grow faster, and be worth more money? So let's circle back here to this idea of what can we do to help our employees feel more bought in, feel more looked after, and want to stay around. And one of the things that this law has passed, and it's still a little bit fuzzy because the rules are still being written, and contributions for these tax accounts, these savings accounts, excuse me, for minors can't be made until next July. But the idea here behind these savings accounts, what are being labeled as Trump accounts, is these are IRAs. Right, these can be set up by your individual employees, and they can make contributions for their children up to the age of 18. Once the child hits 18, they can start distributing, they can start using this money. And so employers come into this in two critical ways. Number one is employers can make, as of right now, up to a $2,500 contribution to these accounts. It does not count towards the employee's income. And it's a deductible contribution to the employer, right? It's an expense. It's like putting money into a 401k, reduces that tax burden. The other benefit here is these are accounts that are individually owned by your employees. This does not have to be an additional expense to your 401k. You do not have to have the same compliance apparatus. You do not have to act as the fiduciary. All right. This is the same as your employee turning around and putting $7,000 into an IRA account. The difference is they're just doing it, potentially with help from you, to an account for a minor. So employees that are younger, with young children, thinking about having children, what a great way to help them accelerate their savings and at the same time do something really good for your long-term business. We need new people. We need younger generations. How are we going to get them there? Well, there are lots of things out there you can do, but money still talks, right? It may not be the most important thing for the next generation, but it's definitely top three. All right. So having the ability to show your employees that you can do something for them, very similar to having the ability to show your customers that you can do something for them as well. Yes, Mike.
So Casey asks, is the 2,500 max employer contribution per year or one time?
Very good question. So as of right now, it is per year. The question that's going to happen when they finalize those rules is, do they put an end date to that? But as of right now, there is not. And so, again, these are discretionary contributions. These are things that can be added back because as long as you have some principles in place for, okay, how are we going to determine whether or not we as an employer are going to make contributions to our employees' account? You don't have to give it to everybody. And when we look at stuff like this from a valuation standpoint, we have to think, well, would an owner, a new owner, a hypothetical owner, continue to make these contributions? Or is this something that they're going to have to look at on a case by case basis? And if so, these types of discretionary, potentially non recurring expenses, again, could be an add back.
Well, I think this is a follow-up. Speaking of end dates, what does permanent really mean for the key provisions in this bill, and how easily could a future Congress change them?
Yeah. Yeah, great question, Mike. So nothing is ever permanent. What I will say is that it's easier to give than it is to take away. So some of these, what Congress is hoping is that some of these provisions are so enjoyable, right? So beneficial that it will be very difficult to back those out. It'll be very difficult to say, well, geez, you've really been investing a lot of money because of something like a bonus depreciation or an expensing. We're now going to get rid of that. And that's kind of what they're thinking in their head. But really, nothing is permanent. It just doesn't have a current expiration date. And I think that's important to know because right now we have the White House and both houses of Congress controlled by one party. All it takes is one election to flip the entire thing, and we could have a different looking tax law. So, what I would say is, as you're planning for these things, don't necessarily think that these couldn't change, but have in mind what you would do over the next 3 to 5 years, given the way that the law looks. And then we can make adjustments over time. But jumping on some of these things, like we need to make an investment in technology, let's say, and now we can do that and we can expense a whole ton of it, or we can take it as depreciation. That would be a really good thing, in my opinion, to do right now. Don't wait to see if these things get repealed or till they expire. Start thinking about it right now. The sooner you do it, the sooner you can invest in your business, the quicker that business grows. So let's now touch on this last. So this is the last piece here about, and this is more succession planning, but it does have an impact on valuation too. This was a big part of the bill, right? If they did not make this change, the estate tax and the lifetime gift tax exemption was going to be cut in half. So instead of the 15 million and 30 million, it will now be starting in January 1, 26. It would have been 7.5 and 15 million. That looks a lot different. Okay, so they have, for now, there is no expiration to that elevated level, to that level that increased the estate tax exemption in the 2017 tax law. Now it's going to be adjusted for inflation, so that's good. It will grow every year. One of the things that we are counseling all of our clients, and we've done a couple of these calculations, is that if you're running a good business, the value of your business, the value of real estate, is likely increasing much faster than inflation. And so we had a client who was very happy. They own real estate, they own the business, obviously. About $24 million total net worth. Great. 30 million. I'm not going to have to worry. boy, I was really worried that that was going to go down to 15 million, and then I'd be, 9 million of my estate might be included in estate tax. Well, if inflation increases at 2.5 to 3% a year, and their business and their real estate grows at the value that it has, within the next 3 to 4 years, they're going to be above that estate tax limit, even with that estate tax limit adjusting for inflation. So this is really an important one. So from a valuation standpoint, know the value of your liquid assets, right? Many of us have businesses that have been growing, but we own real estate. Our parents or grandparents bought real estate when it was cheap. We were way out in the suburbs. Now the city is expanded. Now we're firmly in the city, and our real estate may be worth, and in many cases for our clients, worth more than the businesses. So have an idea, because if something were to happen to the owners, their families could be left with an estate tax bill and only illiquid assets to pay it. And that can get ugly, because then you're going to have to come up with the money to pay the taxes, the liquidity. So you're either going through a fire sale to do that, or you're planning now with things like insurance policies, or you're moving cash outside of the business to maybe a separate family LLC that is going to be invested conservatively to help with liquidity should it be needed. So get that valuation, know what things are worth, okay, and then explore some of these options that you have. This idea of a SLAT, right, a spousal lifetime access trust. These are irrevocable trusts. You can put money or property into it. Okay, property including your business. This is for the benefit of your wife or husband during the time of their life, and it does not become a part of your estate. You can move it outside of your estate. And so while it grows, it will not impact your particular net worth. So these are some things to think about, as well as discounts, right? We're able to use them from a valuation perspective. Let's try to use everything we can within the law to make sure that we are reducing your estate to a level where you hopefully will not have to pay taxes, but it does take some planning. Yeah, Mike.
So, someone asks, the biggest question that came to mind throughout this excellent and informative presentation is this: if I use these strategies to reduce my taxable income, doesn't that mean I have lower net cash flow? Shouldn't that negatively impact my value?
Great. So that's a great question. So that's kind of paying attention to the way that this works. So a couple of things to think about when it comes to valuation is, remember, there's a set of books you keep for tax purposes, right? In those set of books, I want to make sure that I have the lowest pre-tax profit I can report. I'm using expensing, I'm using depreciation, I'm using a cash balance plan. From a valuation, our job is to come in and to look and do a deep dive, right? Part of what we do is like a due diligence before a sale to understand what's non-recurring, what's non-cash, and then what investments have you made to grow the business. And so if I'm going to invest, let's say, $250,000 on a very specific type of technology that has been customized for my business, and then I might have to pay 75 to 80 grand a year for maintenance and upkeep. Well, that entire 250 300,000 that I might have had to put in at the beginning, right, that can be part of that can be backed out, because going forward, that's a non-recurring expense. And so it can be true that you can have a business run to minimize taxes while also having a business that is run to maximize value, if you do it the right way, if you plan for it the right way. And by that, I mean using things like depreciation that are non-cash that get added back, investing in your people, investing in technology, which are one-time or non-recurring investments that are going to pay off through growth over time. That's where your business value comes from. It's not just a one-off when we look at valuation. It's what are you doing now to create an operation that is easy to take over and that is sustainable in terms of cash flow, sustainable in terms of margins. So yeah, that's a great question, but it is possible to do both. It is possible to run a business to help keep your taxes down while also running a business that is looking for how do I ultimately end up with the highest sale value I can possibly get. So here's what you can do right now. Meet with your accountant if you haven't done it already. These planning opportunities start in 25. So there are things that you can do this year looking backwards that you need to know about and you need to discuss with your accountant. Get those appraisals. Know what your business is worth, know what your property is worth, get it updated every 2 to 3 years or when a material event occurs. Partner left. We added somebody else. We expanded. Okay. Discuss these tax benefits with your employees, particularly as it relates to overtime. And if they are thinking about or don't know about something like a Trump account, showing people you care is a great way to get them to work hard for you, right? And then downstream, make sure your customers know not only about things like low income housing tax credit and how that may be able to help their business, but also some of these other. Hey, we were talking to our accountant, and our accountant said that we'd be able to take this 100% bonus depreciation. You should really think about that for your business. I'm sure you have fixed assets that you need to purchase. Think about how you can make other people's lives better, how you can make other people's companies more profitable. That is a really powerful tool. So we're here, Stratus Business Advisors. We're excited to be in Nashville next month for LBM Strategies, but we do all our own independent valuations in-house. We not only develop succession plans with your goals in mind, but we're also there with you to implement them, right? We don't just give you a piece of paper and say good luck, right? Because execution is key here and the world is ever changing. So it's good to have a good partner throughout all of this stuff. So with that, appreciate all the questions throughout. Mike, did we have any more here as we finish off?
Oh, I just was going to say we didn't, but one just came through. This presentation has had so much great information that I feel I need to act on for my business. Is Sam available to talk to me a bit more offline with questions? And if so, how do I book that?
Yeah, that's great. So yes, happy to happy to talk to anybody. We are happy to have a complimentary call with folks and discuss their specific situation, how we might help. What are some things that they can think about for their business as they're thinking values, succession planning, next generation, all of these key buzzwords that require planning. So good ways. We'll send you this presentation, Mike, so that you can distribute this. This QR code is great, gets you to the website. Lots of different information on there. Here's my phone number and email. Call at any time, email me at any time. Great ways to get in touch. And I am always happy to talk. It's really interesting to learn about everybody's business is slightly different. Everybody needs slightly different planning. So do not be shy. Feel free to reach out. We are happy to talk to you and we'll help you in any way that we can.
Great. Thank you, everyone, for being here today. Again, Sam, thank you for covering this very important topic. This was great information for our attendees to have. Certainly hope to see everyone in Nashville at the LBM Strategies Conference. I believe there's still the opportunity to register if you haven't. Go to lbmjournal.com to learn more about that. And as I said at the beginning, we will send out a link to the recording of this to everyone who registered, and we'll have it posted on lbmjournal.com. So, having said that, thanks again to everyone and have a great rest of your day.
Thanks, everybody. Thanks, Mike.
Thank you, Sam.